This is the current federal tax developments for the week of May the 25th, 2026. Current federal tax developments are brought to you by your state society of CPAs. Met Zollars, and this Memorial Day weekend coming to you again from here in Phoenix. And again, we're looking to go over what's taken place here as we get into the last part of May. A little bit weird this time because we have a full work week after Memorial Day. Well, at least 4 days of the work week. So a little bit different than normal, but we'll get along with this one. So we have a lot of things going on this week. A lot happened this week. So first, going to take a look at a Fourth Circuit reversal concerning innocent spouse equitable relief for erroneous tax refunds for those that work with that kind of representation of spouses. Next, we're going to look at the new final regulations modifying information reporting for hot assets under 751, the partnership interest exchanges. We'll then review a warning from the Michigan District Court regarding the trust fund recovery penalty under 6672. That's 6672, pronounce that right. And why delegating financial duties are not going to save a corporate officer. After that, we're going to cover a bill that cleared the House this week. Now, we remember we've had a few of these. They still have to pass the Senate. But this is a legislation that was passed by the House that's meant to address some of the complaints regarding the U.S. Supreme Court's decision in the case of Commissioner V. Zuch. Next, we'll look at Demystifying Notice 2026-33, which is guidance on qualified long-term care distributions from qualified plans after the Secure 2.0 Act. And finally, we're going to basically take a look at what's going on with the IRS's very limited acquiescence regarding mandatory COVID-19 deadline postponements, and what it signals for the IRS's position in the more interesting case of Kwong, and that many of you may be aware of and may be monitoring, and may be planning to do some protective refunds by July 10th. So we'll talk a little bit about that right now. But first, let's go on to our first case this week, which is a case of Catherine L. LaRosa versus Commissioner of Internal Revenue Code. This is a Fourth Circuit Court of Appeals case, case number 24-2034, decided May 18, 2026, which vacates and remands a public tax court decision, 163 TC number 2, that came out on July 17th of 2024. What we're looking at here is the availability of equitable relief under IRC Section 6015F. This is a safeguard for innocent spouses that are facing joint and several liability. And the core issue in this case is whether an erroneous refund consisting solely of previously paid interest actually revives a tax liability that is eligible for such relief when the IRS decides, hey, wait, we shouldn't have given you that money. The Fourth Circuit's decision is going to reverse the tax court's view that, well, just tough luck. And so we'll take a look at that. Now, again, whenever we're dealing with circuit court decisions, I want to remind you that this is only going to be applicable in the Fourth Circuit because it is a published tax court decision. The tax court will only follow this decision in the Fourth Circuit. If you, like me, are sitting here in the Ninth Circuit, well, tough luck. The Ninth Circuit, presumably, either you've got to take the case to them because the tax court's going to follow its published decision until they tell us they've reversed that decision. So you'd have to take the case up to the Ninth Circuit in San Francisco, and then you're hoping the Ninth Circuit will agree with the Fourth. So again, great news if you're in the Fourth Circuit, and potentially decent news if you're not in the Fourth, but still not really something you're going to be able to push through unless you're at least convince the IRS you're likely to take this thing up to the Circuit Court of Appeals. If you did that, then you might find that the IRS might be willing to settle due to hazards of litigation, shall we say. But otherwise, yeah, you're not out of luck. So that's one of those odd little details. So let's take a look again, basically to understand this ruling in the LaRosa case, got to look at a long timeline. This is a 1985 tax fraud conviction for the years 1981, 1982, and 1983. In 1990, the taxpayers and the IRS reached a stipulated settlement. The taxpayers paid the net tax liability for their underpayments, which included statutory underpayment interest under IRC 6601A and penalties. After paying in full, the taxpayers requested a refund, arguing the IRS miscalculated the interest. The IRS eventually issued a refund in 1994, consisting both of Section 6601 interest and 6611 overpayment interest. However, the IRS soon realized that the 1994 refund they had just paid out was issued in error. The Department of Justice brought an erroneous refund suit under Internal Revenue Code Section 7405 in 1996 and won a judgment and placed a lien on the LaRosa's real property. Decades later, in 2019, the government initiated an action to foreclose on that judgment lien, thus getting us to today's case. So, facing foreclosure in 2019, Mrs. LaRosa, because it's an innocent spouse situation here, filed Form 8857 requesting equitable relief from the joint and several liability under 6015F. Section 6015F allows the IRS to grant equitable relief if it is inequitable to hold the individual liable for unpaid tax or other deficiencies. That's the bottom line there. Now, the IRS refused to even process the request, strictly asserting no amount is currently owed and that innocent spouse relief simply doesn't apply to erroneous refunds. Taxpayers took the matter to tax court. When the case went to the tax court, the judge sided with the IRS. In a published decision, the tax court rooted its analysis in the distinction between rebate and non-rebate refunds. Because the 1994 refund was just a calculation error on statutory interest and didn't recalculate the underlying tax liabilities, the tax court classified it as a non-rebate refund, not eligible. Non-rebate refunds, according to the tax court, do not receive a tax liability and can only be removed via a civil suit under IRC Section 7405, rather than through deficiency procedures. Therefore, the tax court ruled she was ineligible for relief under 6015. You've come to the wrong place. Well, Mrs. LaRosa, get her name right, didn't agree. She appealed this case to the Fourth Circuit Court of Appeals. Now, upon conducting a de novo review, that means looking back at everything, going from scratch, the Fourth Circuit dismantled the tax court's framework by focusing purely on statutory text rather than procedural classification of refunds. Right? We're back to, again, you're going to see a lot of things phrased in textualist context when you look at court cases these days, because it's pretty obvious the Supreme Court's down that route. So we go there. The appellate panel noted that Section 6015F1 authorizes relief for any unpaid tax, and that Section 6601E1 dictates that references to tax generally include underpayment interest. The Fourth Circuit pointed out a critical flaw they saw in the tax court's reasoning. The Chapter 63 exception for deficiency procedures does not apply because Section 6015 is located in Chapter 61. We get into these sorts of technicalities, right? Furthermore, the panel aggressively rejected reliance on the rebate versus non-rebate distinction, finding no basis for that distinction in the text of 6015F1. The court also struck down the argument that the original payment permanently extinguishes liability, emphasizing that whether a taxpayer has a liability turns only on whether their current obligations under the tax code are satisfied. Much broader than the tax court viewed this to apply to. So, by adhering strictly to the statutory text, at least as they read it, the one thing we do find about textualism is sometimes we find people can't agree on what the text says. But again, in this case, pretty clearly, they're saying none of this rebate, non-rebate stuff was in the actual text of any code section you're showing us. The Fourth Circuit concluded erroneous refunds of underpayment interest do give rise to a liability for unpaid tax that is eligible for equitable relief under the innocent spouse rules found in 6015F1. The court dismissed, though, the IRS's policy arguments by firmly noting that no amount of policy talk can overcome plain statutory text. That's the court's, that's the appellate panel's view. As a result, this case now goes back to the tax court, who must evaluate Mrs. LaRosa's petition on its substantive merits. Remember, this does not mean she gets relief. All this means is now they have to take that relief up. And that's one of the kind of bad news things sometimes of taking cases like this up to the Court of Appeal. Yeah, you might win this, but you can go back and when you get to trial court, just lose on the, when they consider the direction that the court originally said you couldn't take, they look at that, said, well, you don't meet that requirement either. That was famously the case for the case that got us into the whole question of equitable relief for missed filing deadlines. The first one was on collections. The Supreme Court ruled and said, yep, we can do that. Tax courts are wrong about, the number of days to file a petition being absolute. You missed that and you can't get back anyway. Well, it all went fine, except it went back to the trial court. And the attorney in that case couldn't show she qualified for equitable relief. So again, Mrs. LaRosa may or may not get relief here, but she has a chance now. Remember, you got to proceed with caution here, though, because the initial ruling in LaRosa was a published decision. The tax court is likely going to maintain that position in every other circuit. So again, as I said to start this discussion, if you're not in the Fourth Circuit, you probably need to at least show the IRS that you seriously are willing to take it to the Court of Appeals. That at least brings it into the conversation that the risk that this case could be used by another circuit to rule against the tax court. And when they start getting multiples against them, the odds that they're going to have to back down go up dramatically. So, the IRS might decide not to push it if they thought you had a serious chance. Now, remember, the only problem here, because it's innocent spouse, the non-innocent spouse may very well object in of themselves and sue over this. So, yeah, it gets a little messier for the service there. Again, as in prior weeks, we have our nice little infographic here that shows us, what's going on. It's a visual summary of the Fourth Circuit and how they reversed it. The left side of this shows you the tax court's, decision initially. The interest was not a tax. The classification was a non-rebate refund that the court found could never get you out under 6015. And the liability was extinguished long ago. This was simply overpayment interest, and it's not there. So essentially, the Fourth Circuit in the far right column, they have their reversal. Underpayment interest is tax in their view. The rebate distinction is irrelevant. It doesn't matter. It's not in the code. We're not going to consider it. And refund revived the unpaid status. So yes, at one point their liability was extinguished, but that refund followed by the IRS attempt to reclaim the refund opened up an unpaid balance yet again. So essentially in the center, we have kind of the side-by-side comparison of where the tax court and Fourth Circuit differed. They differed on whether the tax includes interest. Does a refund revive a liability that was previously extinguished? And also, is she eligible for relief in this case? And the answer, from the Fourth Circuit was yes, she is. Again, doesn't mean she gets it. Just means she can argue her case. Next up, we're going to talk about Treasury Decision 10048, May 20th, 2026. And this is essentially the final regulations that came out and modified the information reporting responsibility for Form 75A partnership interest exchanges. Remember, the form the partnership has to file every year, has to file if there is a sale of a partnership interest from one partner to another. That has to give information about hot assets. And there were changes that were made a few years back that required the partnership to provide all kinds of detailed information on that form. They didn't move the date by which that detailed information had to be provided. So what this is meant to do is to alleviate significant compliance hurdles that were put in place by that had to get all this filed by January 31st, which was causing huge problems for partnerships. So it's basically just doing, and in also not much change, not anything really changed in the final rate. So let's go over why we have this. Under Section 741 of the Code, gain or loss recognized by a transfer or partner is generally treated as capital gain or loss, except as provided in Section 751 of the Code. Section 71A mandates that amounts attributable to unrealized receivables, which, by the way, has a much broader definition than you would expect from that name. Remember, always check definitions in the tax code. or inventory items must be considered as an amount realized from the sale or exchange of property or in a capital asset, and that triggers specific reporting. Generally triggers what we refer to as hot asset gains. Okay? To ensure proper reporting, the prior regulations under 1.6050K-1C2 required a partnership to furnish complex 751 computational information to the transfer partner by January 31st of the year following exchange. Now, the regs before that only required the partnership to essentially say there was a transfer and hot assets were involved, but gave no information on amounts. It was decided that what was happening was that information wasn't getting provided and the service didn't have easy access to it. So now they're going back and saying, you got to give us a copy of that information. Tell us what it is. And partnership, you obviously are the party in the best position to know what the hot assets allocation, to that person should be. You need to provide that data. But because they didn't move the dates, it was a real problem. So where you're going to find this is Part 4 of Form 8308. 8308 is a form that generally must be provided to both partners by January 31st of the year following the year of sale, right? Many partnerships were simply unable to furnish this information by January 31st deadline. They don't have all their K1 computation information. They don't have their books closed in many cases by that date. I mean, things are still open. So it was proving an impossible burden to meet. The IRS granted some administrative relief, right? And what happens now is the final regulations essentially make permanent what we had been given effectively as administrative relief. The most significant relief is a complete removal of the old section 1.6050K-1C2. Eliminates direct regulatory requirement to furnish these complex 751 computational information to the transferor by January 31st. That was our problem. They also revised 1.6050K-1C1 to state the partnership will now furnish a copy of the filled out 8308 as a statement unless the form contains information for more than one exchange. Additionally, any substitute statements must now clarify the information will be supplied to the IRS. Because the Treasury and IRS received no comments, they held no public hearing regarding the August 2025 proposed regulations. In essence, the August 2025 proposed rates we talked about last year have now been adopted with no change. So, what exactly do we have now? While the January 31st deadline for Part 4 is relaxed, you must still understand that substantive reporting requirements have merely shifted. They've not disappeared, right? Partnerships must still furnish Parts 1, 2, and 3, the old parts of Form 8308, or a statement with equivalent information to the transferor and transferee by the later of January 31st or 30 days after the partnership receives notice of the exchange. Actually clears up a problem we had before. Sometimes a partnership didn't find out partners had sold interest between themselves until well after January 31st. So now, if they don't find out until, basically later in the year, we're going to get at least 30 days to prepare the parts 1, 2, and 3 of this form and submit them to the service, right? Ultimately, though, the fully completed 8308, including Part 4, computational data must still be filed with the IRS as an attachment to the partnership's Form 1065. And the burden of communicating 71 gain or loss to the transfer partner is in the Schedule K1 process, pursuant to Section 61, or Regulation Section 1.6031B-1TA3. That's where we find it. So, the final regulations are officially effective as of May 20th, 2026, the date they're published in the Federal Register. The amendments apply to returns filed for taxable years ending on or after the publication date. So they don't retroactively cover the basically the 25 return, which is nice, although we're probably following those anyway because we really don't want to follow the prior regulations in that sense. So, and this brings up the point, right, that there's a transition rule for partnerships are explicitly permitted to rely on the previously issued proposed rules for any exchanges that occurred on or after January 1st, 2025, right up until the final regulations were published. So essentially, yeah, we still basically can rely on that. So we're able to use effectively these rules. So while they're not mandatory for this year, you probably want to use them because you probably wanted to use the proposed regs we got last August. So just keep that in mind. And we have, of course, the simplified now, our nice little infographic again. And again, it is on the screen if you're looking at the video version of this. It is in your slides. If you go to our website, download the slides, you'll find the slides have copies of the infographic in it, so you can find it there. And what changed was we got rid of the Part 4 deadline. Deadline stayed for everything else. So we still have the simplified initial statement that has a default January 31st deadline, but if the partnership can show they were not informed of the sale until after, generally after January 2nd, but that would be normal because, let's face it, you're probably not going to receive it on New Year's Day. We're there. They would have 30 days after the day they received it. So essentially, we got some relief even on the parts of that were in the old regs. So we're there. Now, what's still required? You still got to give all the information. 8308 is still ultimately going to be required. They did not strike Part 4. You're just going to put it in as part of the reporting with the partnership. It'll be there. It'll be a K1 disclosure. That information that's in that part of the 8308 has to be there. And so we've got a pretty basically rough comparison of what the reporting was, and when it's going to be required, right? The information including 8308 and the date by which you have to furnish it, if you look at that on the screen. So again, as I said, it can find it in the slides on the website, currentfilltaxdevelopments.com, by going to the, basically weekly audio and video updates, and you'll find the stuff there. And of course, it basically is what we thought was going to happen. What we thought for a few years was going to happen has finally happened because the final regulations got adopted before that January 31st date just was not realistic in any way, shape, or form. Okay, next up, we're going to go to a case that involves the trust fund penalty. This is a case United States versus the state of Richard T. Cole Jr. et al. This is decided by the United States District Court for the Eastern District of Michigan. This is that court's case number 22CV12916. And the decision was published on May the 15th, 2026. Now, trust fund penalties come under IRC section 6672. This penalty is one of the huge challenges when you're representing officers of a corporation, especially one that's been in financial trouble. This recent district court decision in the state of Cole is a reminder of that absolute personal risk that corporate officers and others, you don't have to be an officer to run into this problem, face when employment taxes are withheld but not remitted to the IRS. The concept is, that's why we call it the trust fund recovery penalty. Those funds are taken from the employee, and yes, taken from the employee. Remember, you agreed to pay the employee, let's say X dollars per hour or a salary of X. You're not paying them that. You're taking money from them, right? As required by law, you've got to do it, but you're sending it on then to the IRS. That is the employee's money, not yours. This is the key underlying theory that supported Congress adding this. So you have a personal responsibility to make sure the corporation does not steal from the employee. That's the view of the government. Now, the corporation probably views it more as, I'm not, no. That's just government money, right? That's another creditor I owe money to. And that doesn't cause a problem. That's not how the case law views it. That's not how the code views it. That's not how the law views it. Just very simply. You have to tell you. Now remember, trust fund taxes do not include, though, any tax imposed directly on the employer. And what that means is taxes, the employer portion of FICA and Medicare taxes are not trust fund taxes. Neither is the employer's share of FUTA. Now, just also to remind you, so people don't forget this, in a large number of states, sales taxes are treated the same way, and the same recovery option is given to the state. So be careful. Even in states like Arizona, where technically the Arizona's transaction privilege tax are basically our stand-in for the sales tax, and don't worry, everybody here calls it sales tax anyway, is technically on the seller. But the seller has the right, if they wish, to charge it directly to the customer. But if they do that, now suddenly that is the state's money as soon as the person hands it to you. And therefore, when you don't send it on, you're stealing from the state. A lot of other states have similar rules. So trust fund penalties are a problem. And companies in trouble, often the people who are exposed to this have no idea this rule exists. And it can be very, very badly. It is very difficult to escape this liability by pointing fingers at others, co-owners, or saying there were third-party administrative failures. Bottom line, if you know or should have known, and should have known becomes very expansive, that the taxes were not being paid and you had the ability to pay them, and you had the ability to, and you allowed other parties to be paid when trust fund balances were still outstanding, you just got liability. So let's look at the facts in this case, right? It's a common but fatal scenario for small to mid-sized businesses that get in financial strain. It happens, right? Depending upon how exposed a business is to fuel price sensitivity, we probably have some companies right now that are beginning to experience this level of strain, as prices for fuel remain high. Again, you can survive that for so long, but eventually you end up not paying. And you know what? If I have to have gasoline to go in my delivery trucks, and that person demands cash up front, you know what? I'm probably paying for the gas. Thought being, well, if I don't pay for the gas, we're out of business today. But if I don't pay the IRS, well, I tried that last time. They didn't call. They keep not calling. That's what creates the cycle that ends up with disastrous trust fund recovery penalty problems. Okay. Now, in this case, the company, Associated Community Services, ACS, would be the abbreviation that's used, initially used a professional employer organization, a PEO, which leased employees and handled taxes under its own EIN. However, in 2005, ACS switched to COHR LLC, which acted merely as an administrative service. ACS hired its own employees directly and retained ultimate liability for tax remittance. Now, sometimes you'll see companies do that because, payroll services, and basically PEOs are effectively, and leasing companies become effectively payroll services. They don't exactly cut you a lot of slack about not sending the money in on time. So, yeah, sometimes we see them go to this, where they'll hire them directly and somebody else will just tell them what to do. When cash got tight, right, ACS failed to fully fund the payroll invoices, leading to approximately $3 million in unpaid withholding taxes by 2007. Now, again, we don't know as a matter of fact that why they moved from the PEO to the administrative service was because, hey, I want to be able to hold on to this money, but it's a pattern I've seen, and it's something that you just like, that was not a good decision, is the best you could say, right? And remember, because withheld employment taxes held in trust for the U.S., employees' money due to IRS, not your money, even though you got in your bank account. But because they do, under 7501 of the code, the government faces a direct loss when they aren't remitted. Consequently, because remember, the employee gets credit when they're taken. So you're now stealing from the U.S. government. The reason they don't pursue you very quickly is because they have this huge hammer. And they're willing to use it, right? So the IRS assessed roughly $3.4 million in civil penalties per se against the co-presidents for the 2008 and 2010 quarters. Now, remember, the company still owes $3.4 million. This is a penalty that they now have the right to collect $3.4 million, assuming the penalty is found to be valid, from the company or either of the two officers or any combination, right? That's how it works. But it's a corporation. Irrelevant. You, under the law, had a personal liability not to allow a company that you were in position to have pay the trust fund taxes, to have allowed them to not pay those taxes and pay somebody else instead. That means you now have violated the law. You just became personally liable. The corporate veil will not help. This is a statutory override of a corporate veil. Keep that in mind. Okay. Now, what we have here is, in this case, we have, and taken from the case of Kinney versus the United States from the Sixth Circuit in 1993, it was found to be held liable under 6072. The government must first prove the individual is a responsible person, because that's the key. You've got to be in that case, right? So the taxpayer in this case, Mr. Berlin, tried to argue he lacked actual financial authority, claiming his co-president, who is conveniently deceased, exercised exclusive control, and that he merely forwarded financial data, that he had no actual control over this, right? The court entirely rejected this delegation defense. Applying the Sixth Circuit's five-factor test from Kinney, the court noted Berlin was a co-founder, owned 50% of the voting shares, possessed corporate check signing authority, and signed the corporate tax returns. Let's just say those are all really bad facts, right? The key takeaway here is an officer does not need absolute control over finances. Possessing significant control as a 50% shareholder, corporate officer, signing corporate returns, he had influence. He just didn't use that. Now, whether he didn't use it because he really didn't want the company shut down, or he didn't use it because, he was playing ostrich, or he didn't want to start the fight with his co-owner, it doesn't matter. The minute you don't take steps here, you're in trouble. What could he have done? There's one obvious thing, which he doesn't want to do. Okay, obvious thing, because again, the company's worthless. So at this point, you could say, hey, this isn't as bad as it sounds. When you think about now you owe $3.4 million and the company's worth nothing, which is effectively what's happened. He essentially could have just resigned instantly. Resigned as an officer, the minute that party overrode him and paid something other than trust fund taxes, just leave. It's illegal. You're not allowed to do that. And I am not taking liability under 6672. Right? It's yours and it's yours all the way. Most likely, of course, people don't want to do that because A, you don't want to give up ownership of the company. Maybe it would be worth something eventually. But B, it also probably is where you're getting your money for your lifestyle currently. And C, you just don't like admitting failure. And it is going to be kind of a bad scene with your partners, right? It's one of those things. I can imagine trying to face down your co-owner. It's like, over this, it wouldn't be fun. It'd be one of those things you just want to try to ignore and hope goes away. Bad news for Mr. Berlin. It didn't go away in this case, right? Now we're going to take a look at the IRS Form 433B admissions that were made, and this is where the problem, right? This is pre-litigation administrative filing. During litigation, Mr. Berlin submitted a personal affidavit declaring he never had the authority to cause taxes to be paid. Now, the court aggressively nailed this under the sham affidavit rule. That flat out is not the case. We're not going to let you get with that. Why? Because back in March 2009, Berlin executed a IRS Form 433B collection information statement. Remember, they're still trying to save the company at that point. Under penalty of perjury, explicitly admitting his responsibility for depositing the company's payroll taxes. Oops. But I had to sign that. They're going to close down the company. Well, yeah, but there's a reason they got you to sign it. Okay. You got to remember, admissions made on IRS collection documents are legally binding. You can't conveniently retract them later. People like to change their stories. Well, when I signed that, I didn't know. Well, don't sign anything that's not true. I was told I had to. Well, that was true too. You had to, or they're going to shut you down now. But if you sign that and these taxes don't get paid, because the IRS denies collection relief, right? Whatever, you guys just simply, even though you got a collection alternative, you basically failed on that as well, and the whole thing collapsed. It doesn't matter why, you're going to pay the tax. Once he signed that affidavit, it's there. You'll also find that sometimes IRS can take a look into like state law litigation and find things on the record in other cases that becomes an admission against interest. Like if you were suing your partner, right? You're suing your co-owner, and there was fight between them, and we got into the powers of each. And you claim the power to do these things. Well, that's an admission against interest, and you can't tell different stories at different times. If you do, you're losing. Bottom line, your story has to be consistent. That's also a warning, though, for people representing clients in collection issues, especially corporations and payroll taxes. Remember that, if you're just concentrating on keeping the doors open for the next payroll, you got to realize that if that doesn't work, somebody's got to be thinking ahead of time of, is this a good thing to have signed if in fact the company never gets out of this mess? And did somebody, did Mr. Berlin, did he believe that he was being represented by maybe whoever's representing him in collections? That could be a big problem. It is something that should have been clearly discussed as the problem in that case. But like I say, too often, even we representing clients get too focused on the instant danger and don't think the bigger picture. And in this case, that form, if nothing else killed his case, that form totally did, right? So anyway, let's go on then. Once a responsibility is established, the second hurdle is proving the officer willfully failed to pay. And willfully is not defined the way your client's going to believe it is. They never had to actually say, no, don't pay that. Absolutely, I forbid it, right? That's not going to be there. Berlin had explicit knowledge of the tax deficiencies. He even created internal spreadsheets tracking hundreds of thousands in unpaid trust fund taxes. There's your key problem at first. If you were, let's say that you literally were, an officer, but you were an officer and you only worked in marketing. If you never were aware payroll taxes weren't being paid, you got to watch that word never, then you can't have willfully failed to pay them. But once you have knowledge, because again, as a responsible person, we kind of established you had the power or you had enough influence to make a difference. Once we establish the knowledge, now, not only do you need to worry about the ones you know about, but you can't just take your co-owner's assurance that the problem will never recur. You now have a personal responsibility to monitor that trust fund taxes are being currently paid. And that's where people get into knowledge, right? Despite this knowledge, Mr. Berlin allowed ACS to pay over $24 million annually in wages and supplier invoices, while, and this is also really bad, drawing a personal gross monthly salary of over $20,000. So he was getting over $240,000 a year in salary, which probably had taxes withheld. Yeah, you can see where this is not good. The court cited the Sixth Circuit precedent, which was the case of Brewery Inc. versus United States from 1994, indicating that the government cannot be made an unwilling partner in a floundering business. If the business has known tax debt, paying any other creditor constitute willfulness as a matter of the law. The only viable option to avoid personal liability in this scenario are to resign or to force the company into bankruptcy. Just going forward and hoping it all works out. Once you have knowledge, A, you just picked up liability for all those prior unpaid taxes you now have knowledge of. And B, you have liability for every dollar in the future. I mean, you would have to establish that you had done everything possible and weren't aware of unpaid taxes, maybe because your your partner pulled a fraud on you, totally fraudulently gave you documents and invoices and things that showed the tax were paid. But even then, since he was communicating with the IRS, you're almost going to be like, well, you could have just, got a transcript and you'd have noted there was no payments being made. This is a big problem. And it's not just officers. You'll also find controllers. And that can even be the outside accountant. If you manage to get enough control of the situation, you take enough control over payments, you need to be, anybody, you or any accountant, bookkeeper, etc., or any corporate owner. Once you become aware of unpaid payroll taxes, you need to be very, very, very careful and probably start distancing yourself because there's a high likelihood if they are running up significant unpaid trust fund taxes that this thing's going down. It's a matter of time. And one thing I remember being told by the founding partner of our firm, he passed away at this point now, what was it, back in 1997? Yeah. So it's like almost been 30 years. Wow. Okay. Time goes on. But, as he said, it's amazing how long it takes for a company to fail after it's clear they're just not making it. And they're going to run up liabilities on trust funds all the time they're floundering and going under. That's why you gotta quit. As bad as it is, every controller needs to understand that if they're not paying trust fund taxes, you hand in your resignation. As soon as you're told not to pay the payroll tax deposits, hand in your resignation and leave. That's the only safe move. You can't get them paid. If anybody gets paid other than trust fund taxes, you better have been out the door before it happened. Okay? Or at least out the door the instant you become aware that somebody forced it and got it paid. Okay, again, more infographics to basically to synthesize the core holdings here of the estate of coal and why it summarizes liability. As I said, this is a statutory piercing of a corporate veil. I don't care it's an LLC. I don't care it's a corporation. But we're not liable for debts of the corporation. We're not liable for debts of the LLC. Well, that's great. This is not a debt of the corporation anymore. It just became your debt because you allowed the corporation to violate the law. In essence, you caused U.S. government to incur damages, that is, lost funds. So you're liable. The company's still liable. They're not going after you for the company's debt. Technically, they're going after you, for the damages from the fact that you allowed the company to go into debt. Okay. So on the left, you can see how responsible person status was established through the 5-factor test, which is discussed over there. Emphasizing the ownership, the check signing ability, and then the sham affidavit. Signing that form 433B was a huge problem. And then there is the willful failure to pay. His internal tracking spreadsheets, he gave his own documentation that he knew about this. You're preparing spreadsheets of how far behind we are in paying trust fund taxes. That's nice. Did the IRS's work for them in that case? And his decision to prioritize $24 million in operating expenses and personal salaries and take a salary himself pretty much doomed his defense his delegation defense that he didn't have the power to do so. It was gone. Sorry, guys, it's over. Okay, next up, we're going to talk now about a bill that passed the House this past week. This is H.R. 6506, the Taxpayer Due Process Enhancement Act, which passed the House of Representatives by, as I recall, unanimous vote, at least of those there, on May 19th of 2026. Again, this is a direct response to override the Supreme Court's controversial June 2025 decision in Commissioner v. Zuch that we discussed last year. If this bill is enacted, please remember that it's not law. This bill has not been enacted. It won't be law until it is enacted and put in place. And right now, the House has sent a number of these bills over to the Senate. The Senate appears to be trying for one huge, massive, giant bill, which is great. But if that doesn't come off, Are they going to go back and pass these individual bills? I don't know. And are they going to include something in their giant bill that the House won't agree to? And then are we going to lose all these bills? So it's far from a sure thing, but understand there is movement on this issue, right? So this would alter the IRC to protect taxpayers' rights during collection due process proceedings and ensure that the tax court remains accessible to the taxpayer, all through their challenge under collection due process, even if somehow the IRS managed to make the debt go away, which is what they did in Zuch. Okay. Now, let's review the procedural nightmare that was created by the Zuch case from last summer. U.S. Tax Court is famously the only judicial forum where taxpayers can litigate tax disputes without first paying the disputed amount. In Zuch, the taxpayer properly challenged a 2010 tax liability via collection due process hearings and petitioned the tax court. Okay. While litigating, the IRS utilized its broad authority under the Internal Revenue Code Section 6402A to credit her subsequent overpayments against the disputed 2010 debt. Once the IRS successfully seized enough of her later refunds to zero out the debt, they abandoned their proposed levy and moved to dismiss the case. The Supreme Court ruled in favor of the IRS, holding the tax court jurisdiction under Section 6330D1 for collection due process is strictly tied to an active proposed levy. When the IRS was no longer threatening to levy anything of hers because they already had all the money, sorry, you're there. Now remember, she was disputing that the IRS had failed to allocate estimated taxes properly between herself and her husband, if I remember my history here, for the year in question. And so effectively, she should be able to escape the liability. However, while she's trying to argue that, the IRS just keeps slowly taking her refunds from her. Hint, not a good idea to get big refunds while you still owe the IRS a lot of money. So you can argue that somebody should have noticed what was happening and thought that could shut this whole thing down. But again, this is somebody who suddenly was facing this bill from the IRS, big bill. She was, looking at that and panicking. So she doesn't want to owe them more money. So, she's making sure she's overpaid. Great. But now she's going to lose all those overpayments because the IRS just wiped out her tax bill due. The CDP process was irrelevant because there's no liability any longer, right? So that's the problem. Now, Justice Gorsuch had a rather significant, basically, dissent in this case. He was not happy about the decision. He noted that this forced the taxpayers into district court for post-payment refund suits. And there they'd often find the rigid statute of limitations under Section 6511A had quietly expired while they were distracted litigating in the tax court. In essence, in theory, they should have started a separate action, which is going to be a problem because the district court is going to say, but you're in tax court. That's where you get relief from this. Gorsuch pointed out that essentially, in essence, if the IRS can just delay the game long enough, if they're going to get the money, they're going to come out ahead, right? They can stretch it out in tax court. And by the time we finally discover there's nothing to levy anymore, and now she says, well, I want my money, because that was what she was after from the beginning. Now she's got to go back to, now she's got to try to file in district court, who's probably going to tell her that she didn't file in time. She didn't meet all the requirements to file in district court. So, yeah, it's a problem both ways. So this bill directly targets this loophole by amending Section 6330D1. Under the bill, the revised 6330D1A would allow a person to petition the tax court for review of both the IRS determination and any underlying tax liability that is properly disputed at the hearing. And crucially, it would add Section 6330D1C, a brand new retention of jurisdiction clause. This clause would explicitly state the tax court retains jurisdiction to hear the case whether or not the secretary abandons the collection action. So the IRS couldn't just make it go away by eliminating a proposed levy. The practical impact is massive. The IRS can no longer unilaterally moot a CDP case and strip the tax court of jurisdiction by dropping the levy. Now, in this case, they dropped the levy by just collecting everything. But there are other ways they could more interestingly game the system, shall we say. Now, and also then, to stop the IRS from using this particular technique, administrative accounting measures to drain a taxpayer's resources during litigation, the bill adds Section 6402, which will be this new administrative provision subsection would prohibit the IRS from crediting overpayments against a disputed tax liability during CDP proceedings without the express consent of the taxpayer. It will also amend Section 6330C2A, changing unpaid tax or proposed levy to unpaid tax collection action or proposed collection action. This broadens the scope of issues the taxpayer can raise to encompass alternative collection maneuvers. Now, the one thing about that offset ability, that's good, but now you're in kind of a tough position. Because here's the catch. If, in fact, the taxpayer does not win, the case, let's say, okay, we get there, but they don't get, but the court finds they don't qualify for the relief. Hopefully they haven't done something with those funds, which is being really hopeful for a lot of these taxpayers. I think we'd have to discuss if this came through. Do we want to actually try to use that potentially to make a deposit with the service? Right? Here's a deposit against that, but we're still litigating whether we actually owe it. Those sorts of things, rather than just let them take the check. The way I read the law or the proposed law, it would seem like they just get their check, which, that has pros and cons. Okay. Ultimately, taxpayers will no longer be financially starved out of the litigation while attempting to challenge IRS determinations, if it comes true. Now, and finally, the bill addresses the statute of limitations trap. Currently, Section 6330E1 suspends limitations for collections and criminal prosecutions while a CDP hearing is pending, but not for refunds. We are going to pause. This will pause the refund statute. It amends the section to expressly suspend the running of the refund limitation period under 6511A, B, or C during the pendency of a CDP proceeding. Right? It adds 6330E3 and a cross-reference to 6511I8 to clarify this tolling only applies to the extent of the refund relates to the underlying tax liability properly disputed at the hearing. This ensures if a client later needs to file a refund suit for disputed amounts, they will not be penalized and lose their rights simply because they attempted to exhaust their tax court remedies first. Again, we have our infographics showing both the legal traps that were identified in the Zuch decision, Justice Gorsuch's complaints about that, and then what this bill would do if enacted. And it's so important to go on that again. If enacted, remember, we do not know that this will be enacted. So keep that in mind. Next up, we're going to talk about Notice 2026-33 issued on May the 20th. Now, this addresses a provision in Secure 2.0 Act of 2022, which was Division T of the Consolidated Appropriations Act of 2023, Public Law 117328. This is a new framework for funding long-term care insurance using retirement assets. A major change was introduced by Section 334 of that Secure 2.0 Act. Legislation added new Internal Revenue Code sections, Section 401A39, 72T2N, and 6050Z to allow defined contribution plans to distribute funds for certified long-term care without triggering early withdrawal penalties. Notice 2026-33 provides long-awaited administrative and procedural guidance for tax professionals, plan administrators, and insurance issuers to actually implement these particular rules. Now, under Section 401A39 Cap A added by Secure 2.0, a qualified defined contribution plan will not lose its tax-exempt status, tax advantage status, simply by allowing qualified long-term care distributions. While IRC Section 72TN2 exempts these specific distributions from a 10% early withdrawal penalty, practitioners must clearly advise clients these distributions will remain fully includable in their gross income. This is a way to take an early distribution, pay tax on it from your retirement program, but then use those funds to pay for your long-term care premiums. It's not a tax-free way to pay long-term care premiums. Keep that in mind before you get too excited about this. Your client's going to, if your client is willing to pay the tax, but they would prefer not to pay the 10% penalty, and I'd prefer not to pay a 10% penalty, okay, I'll do that, then it can work, right? Now, this penalty exception is entirely avoided if the distribution pays for a spouse's long-term care coverage, and the employer and the spouse decide to file, the employee, I say, and spouse decide to file separate tax returns. So, if I take let's say I'm married, I take a distribution, I'm under age 59 and a half. I'm neither married nor I'm under age 59 and a half right now, but hey, what the heck? I do that. And I use that to pay for long-term care for my spouse. If we file a separate return, I'm going to have to pay a 10% penalty on the amount used to pay her long-term care premium. The taxpayers must file a joint return if I use it for the spouse. If I use it for my return, yeah, then we're fine, right? If I use it for my care, no problem. But if I'm using it for my spouse's care, we got to file a joint return. The statutory provision for these distributions officially take effect for distributions made after December 29th, 2025, which means some very late distributions last year in theory. And obviously, these distributions could be made during 26, but a plan has to be modified to handle this, right? Now, there are mathematical caps on these benefits. Under 401A39B, the maximum penalty-free distribution during a tax year cannot exceed the least of three amounts. These three amounts are, number one, the actual amount paid or assessed during the year for certified long-term care insurance for the employee or their spouse. The second is 10% of the present value of the employee's vested accrued benefit under the plan. And third, there is a hard statutory cap of $2,500, which the Notice 2026-33 confirms is adjusted for inflation to $2,600 for this year. So, we're going to take a look at the amount you were billed and paid. We're going to take a look at 10% of your basically vested balance in the defined contribution plan. We're going to take a look at $2,600 for a 2026 distribution. It's basically going to be, right, the least of those three numbers. That's your cap. Now, to validate a policy for retirement plan, the code requires a two-tiered documentation process. First, under IRC Section 401A39E III, insurance issuers must submit an issuer disclosure directly to the IRS via fax, going under penalties of perjury that the coverage is certified. The IRS designed this step to balance adequate disclosure while minimizing the burdens on highly regulated state insurance issuers. Second, the issuer must provide a long-term care premium statement to the retirement plan that affirmatively states the IRS issuer disclosure statement has been satisfied. And to enforce compliance, IRC Section 6050Z requires strict reporting mandates. Issuers must file a newly created Form 1099 LPS long-term premium statement, paid statement, with the IRS by February 1st and furnish a copy to the covered individual by January 31st of the year following the premium statement. Right. Now, plan administrators do receive some administrative relief here. They're explicitly permitted to rely on the issuer's premium statement as a safe harbor and don't have to independently verify the IRS disclosure. Now, because these are not eligible rollover distributions, administrators do not need to provide a Section 402F rollover notice, and distributions are exempt from the mandatory 20% withholding for rollover distributions. And also, unlike qualified disaster distributions, these amounts cannot be repaid to the plan over a 3-year period. They're out, they're gone, you can't put it back in. The most critical takeaway for practitioners, though, generally is the opt-in trap. Adding this provision is entirely optional for a defined contribution plan. If the plan does not formally opt in and amend its rules, an employee cannot simply take a standard hardship withdrawal and try to self-declare it's a qualified long-term distribution under 1040 to avoid the 10% penalty. The plan has to allow it. So if you want to allow the employees to do this, you need to get the plan amended in a timely form. But number two, be careful with your clients. If you don't deal with, you're not involved, you're not advising a plan, but you have clients who are employees, and they said, oh, my buddy told me that I can take money out of the plan, out of my 401k plan, and use that to pay, my long-term care premiums. I take hardship distribution, use it for that. and not have to pay the 10% penalty? No. Only if the plan allows it under this rule. And that's going to be the key takeaway here. Otherwise, they're going to pay the 10%. Now, the amendment deadline has been extended to December 31st, 2027 for most non-governmental plans, as long as the plan operates as if it's amended currently. So, now that does mean that a plan right now is going to be committing to getting that amendment done by the end of next year. So if you have plans, you want to talk about whether or not you want to do this. That's going to be a key issue. Okay, again, we have our infographic here. It's the caps on distributions are illustrated here. The 3 in the center, right? Because it does it that way. Tells you what it's there. It's also the mandatory issuer disclosure directly to the IRS and the premium statement that goes to the plan. And then the plan has to opt in, right? 401k, 403A and B, and government 457B plans can opt in these rules. Traditional IRAs are not eligible for this, right? You can't take it out of there, nor could a defined benefit do it, right? You have limited numbers of plan types that are eligible to do this. That's crucial. Next up, let's talk about here an IRS action on decision that when I first saw it, I said, well, this is weird. They're going to take action on the issue in the case of Kwong. Because whenever we talk about Kwong, we'll talk about Kwong here in a second. But usually when we talk about Kwong, we always talk about a case of Abdo versus Commissioner as well. Okay. What Abdo versus Commissioner 162 TC 148 that was issued in 2024, which is a published tax court decision, and Kwong versus United States, which is case number 23267, the federal courts of claims from November of last year. They both have rulings on the 2019 version because Congress amended Section 7508 Cap A in 2019 to add provisions that automatically triggered filing date relief when a taxpayer was in a qualified federal disaster. Now, that timing proved interesting because in March 2020, the entire country became part of a qualified disaster area. When President Trump, in March of 2020, declared the national COVID-19 disaster, a disaster declaration that was not ended until July 10th of 2023. Now we're going to get into this. If you know what Kwong is, you know why that July 10th date is key. And you know about some of those things. But 7508A grants automatic extensions of time to file certain documents with the IRS. Also suspends the, basically various penalties and interest from accruing during that time frame or being assessed during that time frame. Right? You can't go after them. And also automatically treats everything filed as if it was actually filed on the original unmodified due date. But we treat the date paid, if it's a refund, as the date the IRS actually issued the check, which means that almost always, if you filed on the extended due date or somewhere after the original due date, and you had a refund coming, you should have gotten refund interest if you're covered by this. Now, during COVID-19, the IRS took a very narrow view of how this rule applied. Now, it's interesting because in 2021, Congress went back and explicitly changed this rule. I think they finally figured out after looking at COVID and how COVID was playing out about maybe we were a little too generous. Okay, so that said, what the IRS did this week was have an action on decision related to the Abdo case, the 2024 tax court case. That case only dealt with whether or not Abdo had timely filed their tax court petition. Right. That was the key. Their tax court filing deadline was after the date initially set as the beginning of the COVID-19 disaster. But well before, well before July 10th of 2023. But I mean, it wasn't way far. It was in a few days, in 60 days, which the IRS is going to play on that here. Okay. The IRS released an action on decision responding to the tax court's basically unanimous holding. It was a reported decision in Abdo v. Commissioner. Now, the tax court said they weren't going to rule on it, but because they said the plain language of 7508 Cap A, as it was written in 2019, amended in 2019, required that the tax court, hold open the time to file the petition for at least 60 days. But they said, reading other parts of this, it seems like it's possible that it actually kept a lot of things open all the way July 10th to 23, but we're not ruling on that here because the 60-day reading would get, or basically a shorter reading would get us there. And so, the IRS had a shorter reading they were okay with, so, they went with it. So while this action on decision offers a nominal concession, when you pay attention to it, it reveals the IRS is firmly entrenched in its restricted position. And that is why not long ago they announced that they were going to appeal what is a far more significant holding of the federal court, of the Court of Federal Claims, about the ability for taxpayers to recover penalties, interest, and get paid refund interest for items that fall within the date from March 10th of 2023 to July 23rd, or to July 10th of 2023. That's the Kwong case. They are disputing Kwong, and they make it very clear here. Plus, it also means they also, are saying they're, and I think they accepted this one because they don't want Abdo, to try to have to defend something like Abdo and then get thrown back into the whole question about whether there's equitable relief. So we dodged all of that. So it's not really as big a deal, but it does allow us to briefly discuss Kwong. Okay. Now, what the tax court did in Abdo. The tax court was abiding in 2819 of Section 7508 Cap AD, which provided a mandatory 60-day extension for qualified taxpayers during a fairly declared disaster. The tax court unanimously ruled this statute unambiguously created a self-executing mandatory postponement period for time-sensitive acts, including filing a tax court petition. The IRS tried to argue it only applied to those items the IRS later decided were extended under their basically the standard old style rule that grants them the ability to extend for up to various time periods, up to a year for various acts. They're saying, well, no, we have to select it. Tax court said, that's not how it reads. We're going to get everything you could extend for mandatory 60 days, and then you can, on your own discretion, add other things, and you can stretch it out to a year. That's how you should have read this statute. So, they invalidated Treasury Regulation 301.7508A-1G1 and 2. The extent the IRS tried to limit the mandatory relief only to acts specifically chosen by the Secretary under discretionary authority. So ultimately, what the court established was a minimum automatic postponement window running from the COVID-19 disaster's earliest incident date, January 20th, 2020, and that was found, to March 20th. This got them in. They were just slightly late. They were inside this window. Bingo, we're good. We're there. Okay. In response, the IRS has now issued, 2 years later, almost 2 years later, Actions on Decision 2026-01, which grants an exceptionally narrow concession. The Action on Decision states the IRS acquiesces only to the specific outcome that a mandatory 60-day postponement existed from January 20th to March 20th, 2020. Crucially, the IRS explicitly states it does not acquiesce in the court's reasoning. This is an acquiescence in result only, nor does it accept the invalidation of the regulation. Okay, gang, that is telegraphing that we are fighting. This is not a sign we're backing down on Kwong. The service remains committed to its interpretation that the phrase "in the same manner" in the statute requires the IRS to exercise discretion first. The IRS aggressively rejects any interpretation that would result in postponement beyond that initial 60 days. I'm not sure you can read it to say that the 60-day gets in, but the others don't. I think that's the IRS getting really, it's like, I think the courts will more say, no, that implies the court wants they want an automatic extension. It's not automatic, got to wait for the service, so therefore it's got to be everything you're allowed to do. Right? This absolute right, though, to accept any postponement beyond March 20th puts the IRS on a direct collision course with Kwong. If you've not heard of Kwong, the Kwong decision, Federal Court of Claims case, November 25th of 2025, case number 23267 of the court. The AICP has a page, at least for AICP members, that is devoted to Kwong issues. There's been a lot of discussion of Kwong. You can actually search for, people holding CP courses specifically related to Kwong. Right? Kwong is a potential refund situation, but a clock that's running down quickly. So let's talk about it basically. We're not going to go through the full Kwong and whether you should or shouldn't file and all those things. That's a whole nother long discussion. But in Kwong, the Court of Federal Claims addressed the outer limits of the open-ended COVID-19 disaster, applying the plain text of the statute. Now remember, the statute does not exist in this form any longer. This is the unique way Congress wrote it and modified it in 2019, and not considering the later modifications they made in 2021. So it's a one-way only sort of thing going on. So keep that in mind. Okay? So it said in this case that because the disaster declaration made open until May 11th, 2023, oh, that's right, got in that case. Mandatory deadline extension ran continuously from January 2020 all the way to July 10th of 2023, which is 20 days after. That's right. It was May 11th was the date it was terminated. But then they say, then the 60 days runs. That means July 10th is your date. To defend this, the IRS asserts this multi-year postponement creates severe uncertainty in tax administration and effectively allows FEMA to suspend tax deadlines for years without the input of the U.S. Treasury. To defend its regulatory framework and strict 60-day cap, the Department of Justice officially filed a notice of appeal on May 15th. So basically, as this went, the same day the AOD came out, the IRS said, oh yeah, we're appealing Kwong. So bingo. This definitely was done in conjunction with figuring out how they're going to respond to Kwong. So this AOD serves as a clear warning to practitioners. The IRS will not administratively honor the expansive multi-year deadline recognized by the Court of Federal Claims in Kwong. Right? Now, Kwong case is heading to U.S. Court of Appeals for Federal Circuit. That means we're not going to have an answer for quite a while, almost certainly. Tax professionals should expect the IRS to aggressively litigate any refund claims or petitions that rely on COVID-19 statutory postponement extending beyond March 10th. This means if you want to preserve, now this is not a no thinking decision because this is going to cost money. It's going to take work. It involves filing a bunch of 843s potentially, and they may come to nothing. And, and the clients will get letters then denying it. And you'll get complaints about why did the IRS, why did you get me in trouble with the IRS? And we'll get into those things. So it's not a no-brainer to file these things. It is one that definitely you have to have a conversation with the client about the pros and cons. I would also suggest a conversation with them about, I'm going to have to pay me to do these. They may never come through. It may never work out. But you're going to have to do it. The IRS doesn't ever have to take a protective claim and hold it in protective mode. They generally do under the Internal Revenue Manual, but it's not effectively binding on them. If the IRS simply disallows your claim, then you have to decide within 2 years you're going to file suits. You're going to hope like mad that Kwong is settled. Kwong is resolved in our taxpayers' favor within the 2 years, and then the IRS doesn't decide to just dig in and say, well, that's only one circuit. So you may have to file all kinds of things. There's all kinds of reasons why filing this may be a bad thing. Your client's going to be upset, and there's no way I guarantee you're going to get the money. In fact, if I had to bet, be a betting person in this realm, I would bet that even if some taxpayers do find a July 10th date, there may be limitations on what exactly it applies to. Maybe other issues. The IRS may dispute whether the extra 60 days goes beyond the ending of May 10th. The court might decide that was the deadline, in which case then we're already past the date. The May 11th date, we're already past the 3-year period. What we're looking at here is the 3 years after return was filed. So that's a deadline for returns that are filed, right? The secondary deadline is 2 years after a tax was paid. Okay, well, since everything's considered filed and, on that date, we got the 3 years. But 2 years after the tax was paid. If you paid penalties recently that related to those years, then you probably have a bit more time to file the claim for refund. So keep that in mind. If we do get a positive go signal on Kwong refunds, then you might go forward. Whether the Congress would then administratively just open up the statute, which is always a possibility for everybody to get their refunds because people don't yell at them. That's also, I mean, there's all kinds of ways filing a claim for refund could be just, you paid me fees for nothing. I'm no better off than we had. But you have to have that discussion. But the decision day, a very likely decision day, is coming up, July 10th. You don't file by July 10th, then I would say the odds of you getting any money just went down a whole bunch more. That's the key. So we gave you a nice little diagram here of the judicial holdings and the IRS's stance related to these COVID-19 extensions. Now, Abdo is not really probably something your client's directly interested in, but Abdo got everybody thinking because the tax court said we're not going to rule on this, but obviously it was kind of clear how they thought it should read, and the Court of Federal Claims took them up on it. Now, your only problem is if you're going after a refund, you're not getting into the tax court for the most part. We talked about potentially you get in there now, for instance, spouse relief. If the IRS came back and is trying to get you to repay a refund you shouldn't have paid, they shouldn't have paid you, but yeah, you're not going to get refunds in there generally. So, yeah, we're going to probably need the district court filing, and therefore the tax court decision won't help us in district court except to the extent that the district court might find it persuasive or in the Court of Federal Claims. Now, the Court of Federal Claims right now appears to find it persuasive. Whether the Federal Circuit will agree and whether other judges would follow along with that same decision in the Court of Federal Claims is open, or same, the other groups. But yeah, it's interesting. So just think about it. If you haven't looked at Kwong, maybe think about whether you have any clients. I mean, the clients you're really going to be worried about, I think most people will say under Kwong, are those that paid significant late filing, penalties for returns that were late from July 10th, we said basically the 2021 filing season, after January 20th of 2020, theoretically is the date should start, all the way to July 10th of 2023. If clients were actually assessed and paid the penalties during that period, you'd file the claim for refund. You do that. They're big. If they paid a lot of interest, because interest can't run during that period. They had a significant tax liability. There was a lot of interest during that period. Claim for refund. Some other things, you might worry about. You'd be looking for virtually any of that. Or, as I said, if they had a big refund, right? They got a significant refund during that period. The IRS didn't pay interest because, they paid it back within, like a week and a half of when you electronically filed the return. You may be able to get late payments interest then because it will be the date you actually filed the return. That will be compared to April, that'll be considered the date the return was filed. Right, in essence, that'd be considered, April 15th will be considered the date return filed, date filed return. That'll be the date the return was filed, and the date the IRS finally pays you the refund is the date paid. And we're going to work kind of back out of that situation. So be aware. But right now, the IRS is selectively non-acquiescing on the COVID-19 extension issue. They acquiesce in a case that really can't come back to bite them in any way, shape, or form at this point. And they are not acquiescing on the parts of that reg that would result in some rather big refunds. If the Kwong decision were to be upheld and the other circuits go along with it. We'll see how that goes. This has been your current federal tax developments again for the week of May the 25th, 2026. As always, I'm Ed Zollars here from Phoenix, Arizona. Again, our email address there, edzollars@currentfederaltaxdevelopments.com, is where you can send any questions, comments, etc. about this program. I also do keep my eye on the discussion forums for the Arizona Society of CPAs, their Connect site, New Jersey's Connect site. the Connect site for Minnesota, Illinois, and Washington and Idaho. If you have any questions on tax matters, raise them there, and I see them. I may respond to them there. Otherwise, we will see you back here next week as we enter the month of June. Not exactly considered good news for those of us here in the Valley of the Sun, here in Phoenix, the Phoenix metro area. Yeah, that means that we are about to bid farewell to highs in the 90s and say hello to a long run of highs with the century mark and above. Fahrenheit, yes. And for those of you on the Celsius scale, yeah, we're going to regularly be above 40. And you just sit there crossing your fingers we don't go hit 50 again. We've done that a couple of times in our history. We'd prefer not to do it again. But who knows? We'll see how the summer goes. It's Phoenix. Anything could happen in the summer. So in any event, though, we'll see you next week here on Current Federal Tax Developments.